Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions related to three different topics: wealth building, commodities, and/or financial topics. So I'm going to dive right in, take a look, see what people are sharing, and share my opinions. If you want to follow at finding_finance. If you want to join our community, learn more about investing. If you guys are always looking on YouTube, searching to learn more about financial investments, if you're searching to find out more about market conditions, this is a perfect community to join. You're going to fit right in. I'm obsessed with this stuff. I watch it, I follow it, I read it, I translate the technical charts, and I can teach you how to do all that. And I can tell you, this weekend we're going to talk about portfolio position sizing, risk reward setups, physical metals, portfolio allocation to all this stuff. If that's something that you are interested in, definitely give it a try. We have a coupon code Black Friday. It's one word, Black Friday together. 50% off the first month if you just want to try it. And then if you want to sign up for a yearly membership, go ahead and use that code and save some money. So we've got Christine Guerrero here. She says, I hope they've been cheating so we can adjust down OPEC spare capacity. And she's talking about OPEC spare capacity and the OPEC members cheating, where the spare capacity is a lot less than what people think. She says that overhang is very tough to swallow while remaining bullish for 2025, in her opinion. Javier Blas said the elephant in the room is UAE. Crude oil production is coming under increasing scrutiny from barrel counters, some of whom are questioning official data released by the key OPEC members. And they might be cheating the system, the quota, so to speak. Financial Juice just says Kremlin, Putin has repeatedly said he is ready for dialogue over Ukraine. So there are some things going on in the background that could impact the sentiment around gold, silver, and oil. And maybe, perhaps, that's why we're seeing it sell off in the short term. Some people say, well, it doesn't really matter. Um, Maybe it does, maybe it doesn't. I think the markets may use any excuse to sell off gold and silver and potentially oil. Oil, again, is a translator of credit creation into inflation. So if someone wanted to push oil down, I would release this type of narrative and then go at it. And then it's a form of quantitative easing, if you want to look at it, because lower oil prices is the is a transfer mechanism of lower inflation. Bullish trend. So I don't know how to pronounce that. Shachter on oil, $70 to $85 range for first half of 2025, and then $90 in the second half, according to this Shachter person. I'm going to tell you something. This is what I'm going to say to everybody. I've been in these markets for a really, for a pretty long time. I've seen a lot of market predictions, just like I read there. And I will tell you, a lot of them are wrong. A lot. So I don't use market predictions for anything at all. What I look for is the discrepancy between price and value. And you can do that using ratios. And what I see with oil and what people are calling for, some people, is we're at a ratio of about 1 to 38. So 1 ounce of gold to 38 barrels of oil. Historically, that is the second cheapest time in history outside of 2020 timeframe that we've had ever. So when someone says oil is going to go down to $30 a barrel, and if gold's at $2,500 to $3,000 an ounce, they are calling for a ratio of 1 to 100 or 1 to 75. They're literally calling for a greater than 3 standard deviation event, which is really difficult for me to swallow. Most of the crashes have occurred when the ratio was around average. or above for the big moves where oil just collapsed. It doesn't mean it can't collapse. But when you're coming from a ratio that's the second cheapest in history, I find it hard to get cut in half again. Now, it's very possible. I'm not saying it can't happen. I'm just saying that if it were to happen, you would have the greatest long in history that you should be putting on if that were to occur. I mean, that's the event where we should push our chips in, bet it all, because you are now greater than three standard deviations away from the normal, the median ratio. Coming here, the importance of reinvesting dividends. I know some people, I invest in dividend paying stocks. I reinvest my dividends myself. But you can see the difference of dividends reinvested versus dividends not reinvested of a portfolio. And you can see it starts out basically at zero. I don't know what the given information is here, but the difference here is between earning $1 million over a long period of time versus over $3 million by reinvesting dividends. So the difference is over $2 million if you reinvest your dividends versus not investing them over a 40-year time frame. So bullish tankers as Iran will turn back toward floating storage for unsold barrels, says All Things Ventured. And this is Iranian oil exports, says we believe the larger Chinese independent refiners will back away from Iranian barrels imminently as they have exposure to US banking systems and only started buying Iranian crude this year after receiving guidance from the US State Department that sanctions would not be enforced under Biden. We previously thought larger Chinese independent refiners might stockpile Iranian oil ahead of January before sanctions really tighten up. But caution appears to have crept in already. And this is Iranian oil exports ripping higher here. And then perhaps we get sanctions or something. You can see that the exports really drop. We'll see what happens there. Come down, unusual whales. HR professionals, managers, and frontline employees all agree the quality of the on-the-job training has declined. Do you agree? I would say that my on-the-job training was very poor the entire time I worked. That was from 2004 onward. So I don't think on-the-job, I didn't get really much training at all. What I did is I sat by people who worked there for a long time and just asked them 1,000 questions. And that was really my training, was just fumbling through stuff and asking people. I don't even if you know this, but they don't even train you using their material resource planning software, their ERP and MRP systems and stuff. They don't do any training. So I find it that it's really difficult for people to get onboarded, actually get a computer when you get onboarded, and then actually being ready to use the computer with like 8,000 logins and all the security codes and all this other crap that they put there, and all the two-step process junk, and then changing your password every, once a month or something like that. It's a pain in the butt. And in all honesty, guys, it, it's such a waste of time. It's such a waste of time. Even though they pay you, it is such a waste of time at half these places. It was such, I don't know. The on-the-job training is pretty bad, is what I'll say. Avoid self-destructive investing behavior. So let's just read through this a little bit. It says individuals who cannot master their emotions are ill-suited to profit from the investment process, says Benjamin Graham. So this is what you want to avoid. Emotions can wreak havoc on an investor's ability to build long-term wealth. This phenomenon is illustrated in the study below. Over the period from 94 to 2013, the average stock fund returned 8.7% annually, while the average stock fund investor earned only 5%. Why did investors sacrifice close to half their potential return driven by emotions like fear and greed? They engaged in such negative behaviors as chasing the hot manager or asset class, avoiding areas of the market that were out of favor, attempting to time the market, or otherwise abandoning their investment plan. Great investors throughout history have understood that building long term wealth requires the ability to control one's emotions and avoid self destructive investor behavior. And the average stock fund 8.7, the average stock fund investor return 5%. And what I do is the exact opposite. I go exactly where everyone hates things. And then I look for patterns. I make sure that it's cheap. And then I go in. And that is the exact opposite of an emotional investor. And if I say what I'm doing to most people, if I even on YouTube, if I tell you guys on YouTube where I'm going and what I like, most of you will say it's a horrible spot to be. And that is basically telling me that I'm in the right place, looking at the right areas at the right time. Everyone's going to tell you to go buy crypto or technology or AI, and that's most likely the worst spot to be. Here's Lance. It says the largest U.S. home builders based on 2023 new home closings. So we have D.R. Horton, about 91,000, Lennar at 73, Pulte Homes, 28,000, and NVR, 21,000, and Meritage Homes, about 14,000. So giant home builders are eating up more market share. Just look at Lennar. This week, Lennar, the number two largest home builder, announced that it is requiring Roush Coleman Homes, the number 21 home builder. And you can see home builders down here and just who controls the entire market. D.R. Horton is a powerhouse. Lennar is and Pulte Group. Once you get below Meritage Homes, you can really see that these guys are much smaller. The smaller guys provide a ton of leverage, though. I will say that. A ton of leverage to the price move. Lots of laugh out loud banksters. Comex option expiration day. Here's Comex open, and then you can see just the huge selling pressure move. Now, here's the thing. Do we use technical analysis if we think that there's crap going behind? We still use it, and we should still take it into consideration. Is this being manipulated? I don't know, guys. I really don't know. Maybe to some degree, it's amplifying moves on the short term. Maybe. But it is weird on some of these days where it just goes dropping like a rock. And you ever notice that it's very rarely to the upside, it's usually to the downside. So Jenny says getting a Canadian mine into production can take up to 25 years. Canada is resource rich, but many other countries also have resources. They've spotted the opportunity and they're chasing after it pretty aggressively. Gift link for a limited time. So BHP CEO Mike Henry says Canada risks losing investments in critical minerals to global rivals if it doesn't cut the red tape. So my question is, I know I got a lot of uranium guys on this channel, a lot of guys liking, copper and gold and silver and stuff like that. If it really is 25 years, or even if it's half that, is Canada even a good jurisdiction? And I question where the bad jurisdictions really are. Is America and Canada the worst jurisdictions while other ones are better? And the perceived threat is not as big in Canada and America? But maybe that's where the biggest threats are. And maybe it is that they have so much red tape that we won't even get some of these mines into production anytime soon. Maybe they're all over a decade or two. 2 decades, guys, that's ridiculous. At that point, I wouldn't even invest in it in my age because that would put me out almost to the average lifespan of a male. It's getting up there. So this is a big problem, huge problem. The top 20% of earners in the U.S. hold roughly 71% of total U.S. wealth per YF. The bottom 50% collectively own just 2.5% of the nation's wealth. I don't think you can change that, though. That's a function of of things in order to be successful at life. The bottom 50%, and I'm not, going to knock them too hard here, but I mean, you got to be smart, and then you have to have personality traits. And if you're smart, you're probably going to be a top earner. And if you've got certain personality traits where you prefer saving versus spending and stuff like that, well then you're going to go up. And usually smart people have that preference more so than dumb people. Smart people make smart decisions. Smart people have higher FICO scores. Smart people have lower insurance costs of car insurance and stuff like that. They shop around. Insurances give you discounts and look at your FICO score. And it's all interconnected. So you're saying this is really what it's saying, that really smart people who tend to save hold the majority of wealth in the world. And people who are not as smart and don't save don't have as much wealth. And I'm like, well, duh. I mean, that's kind of what it boils down to. And there might be some people who don't make a lot of money that can't save. I just don't know how many there are. And I'm sure there are some. Don't get me wrong. But it really, all that it boils down to is people with certain personality traits that tend to save, that make good money, all of the wealth accumulates to them because they're actively trying to do it, is what I'm saying. Be one of those people. Actively think and be one of those people. Logan says a potential 40% decrease in home prices is noteworthy. Here is the historical overview of home price data going back to 1942. So I'm going to go to this person here. This is what they claimed. Housing analyst Melody has called for a large drop in home prices in 2025. And this guy TikTok says, I agree. And this is what they say. I think a 40% drop in home prices should come in 2025. I don't agree with Schiff that home prices will collapse by 85%. No way. So Logan posts the historical price movements of the housing market going all the way back to 1942 of every single year. And the majority of the years, you can see that we were in a boom phase in the 40s. Then we had a slowdown from 48 to 49.50. And it only appreciated by 2% and 0%. That was a slowdown in the real estate market. Then we started to appreciate again, and we had another slowdown in the mid 50s, where it only appreciated 1%, 0%, 1%. And it did that for a while. It was the demographic that was slow during that time frame. Remember, think of war and stuff like that. The biggest declines over this period were all when we had forced selling and overbuilt at the same time. So we had too many homes and a bunch of garbage loans. The biggest declines there were 5%, 12%, 4, 4, and 4. And we bottomed in the 2011 timeframe. So that was the biggest bust. And these guys are saying, oh, it's going to go down by 40% in a single year. Yeah, crack is a hell of a drug, guys. Cocaine is a hell of a drug. These guys are on this. It doesn't jive with history. Now, there was another major time frame in history where we got decimated by homes. Like the home price fell rapidly, and that was in the 1920s, late 1920s, early 1930s. And that was the big problem that created deflation and the banking problem. It was bad loans in the system. That also had a monster move similar to 2007 to 2011. Those were the two times in history that's occurred. And right now, we've got record low foreclosures, no forced selling, and a whole bunch of home equity. I'm sorry, but these people are on drugs. They have no idea what they are talking about. Zero. And if Schiff said that we're going to fall 85%, how? I mean, maybe if there was some like ridiculous, like we went to war and we were like bombing out homes, then yeah, I mean, you're not going to buy a completely destroyed house or something like that. That's yes, okay. Granted, if we don't have a war on American soil, I don't know. This seems very extreme. Trump plans to seek money from Congress to replenish the strategic petroleum reserves. So looks like they want to fill that up. I'm sure they want to push the price down when they do that. That's my guess. Jesse Livermore says this is actually the calm before the storm. Enjoy it while it lasts. Next year is going to be an absolute crap show. And what I'm going to say is this: generally, the slowdowns come from the real estate market. The big deleveraging phases come from real estate. All of them. All of them. And we do not have a deleveraging thing going on here, at least not in residential real estate. And that's where the bulk of the loans are at. 70+% of commercial bank loans are against residential real estate. If there's no pressure there, I don't think you're going to get this big move. Now, that doesn't mean that we can't get a stock market sell-off and we get a big sell-off in the stock market. That is not what I mean. I'm talking about deflation, deleveraging event. We could easily see a technology bubble and have that pop. Totally agree. So, two different things. One is the complete destruction of the economy. The other, I think, will be more around a certain sector or group of sectors that pull back in the stock market, much like 2000, 2001, potentially. Nat gas, looking at the point and figure chart, I know some of these guys like sharing that, but the point and figure chart is pointing to a $5.50 target, just an FYI. Peter Lynch says the best way not to be scared out of stocks is to buy them on a regular schedule, month in and month out. The Great Marti says soon the entire crypto sector will sell off 40 or 50% in a single day. It will be a sight to behold. Pin this post. Okay, I'll pin it. I'll pin it, dude. I'll pin it. I don't know if it's going to fall that amount in a day. I have no idea. Be careful of what a lot of these guys are predicting. I know people want to predict something and be right. All I want to do is make money, and I don't care if people think, I don't care if someone pats myself on the back and says, "Oh, you were right." I don't care. Doesn't matter. I want to make money. Want the portfolio to continue to track its way up over the long term, and I'm okay with not getting, not making some calls that are right or wrong in the short term. I don't care. I'm in it for the long term, and I think I've got the long term nailed. And in the short term, people are going to be making these calls left and right. And we've seen it all already. S&P 500 top, and I do think that we'll eventually top here at some point. And that's my view. So here's lithium and battery tech commodities have bottomed according to rock bottom entries, and it does kind of look like a double bottom. What you see in these is you see a large impulse move off of a bottom. You see these big moves up, very quick, very rapid. Boom, 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 boom. And then you'll see like this is a double top here. It's offset to the right-hand side. It could also be a Batman pattern, wing, middle, and then the other wing. Then you go into a long, slow decline compared to the move higher. You get to some sort of bottom period, and then you see a large, big, forceful move up, and then this is a flag pattern. So I do think that this is working its way on up. We've got declining volume as this fell back of people slowly selling out. And then we see the bullish divergence in the relative strength indicator. I was very much quicker. I was right on this corner here, buying the lithium area. And some of the companies captured this big move, and we're still in them, waiting for the big stage 2 breakout. So I agree with them. Completely right. And the better you get at investing, the quicker you can pull the trigger on these moves right at the breakout point. Kevin Bambro says, I'd love to know who the sellers have been and what they did with the cash. Okay, so let me go down here first. MicroStrategy has acquired 55,500 BTC for $5.4 billion at about $100,000 per Bitcoin and has achieved BTC yield of 35.2% quarter to date or whatever it is and 59.3% year to date. As of 11/24/24, we hold that amount of Bitcoin acquired for $22 billion at about 57,000 per Bitcoin as the average price. Kevin says, I'd love to know who the sellers have been and what they did with the cash. I can only imagine the quantity of real assets I could get a claim on with 5.4 billion versus the stupidity of owning some digits. This Ponzi will end in pure comedy. I agree with Kevin. 100% it's a Ponzi scheme. Now, how high can it go? I don't know. But it doesn't matter. I'm not in it. I'm not playing it. And I will talk about it, and we'll follow it and monitor it. But I do think that there's a lot of risk in that area, and you're just owning some digits. Completely agree. So Don says this is the quote of the day. There is no means of avoiding the final collapse of a boom brought about by credit expansion. Credit expansion, that boom, comes from the real estate market. That's why I made those previous, things about the home builders and housing starts. That is credit expansion. That's where it's coming from. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. So credit expansion can also be your money supply, fiscal spending. So you've got two ways of increasing credit. You can do it through monetary expansion of bank loans, or you can do it through fiscal spending and government expenditures and stuff. He's talking about fiscal expansion here. And then if you continue to do that and run it and run it and run it, you're going to kill your currency. Lance says high income job markets tend to have higher priced housing markets. No way. I would have never guessed that. Really? High cost of living, high income cities have higher real estate prices? I would have never guessed that. Obviously joking. Freight futures, we were up on Capesize and Panamax a little bit, and we were down on VLCC, Suezmax, oil tankers. Right here, we've got in 1960, mining contributed nearly 20% to gross domestic product. Today, it only accounts for 0.5%. Crazy. It says, while mining operations have become far more efficient and productive, these improvements alone do not explain such a steep decline. The real issue lies in the U.S. economy's overwhelming reliance on imported ore from abroad. With deglobalization trends accelerating, this dependence now poses a growing national risk. Mining importance has arguably never been greater, and policymakers may need to rethink their long-standing negative approach to the industry. This shift could pave the way for a fundamental change in institutional support and a renewed flow of capital into an often overlooked sector. And there's the decline from 17% in the 1960 or so? Yeah, 1960, all the way down to where we are today. Just to show you guys how little mining is as a percent of GDP. It's all financial garbage now. Here's Logan, and I like going over some data. Did you know that 40% of homes are entirely mortgage free? Homeowners are in a strong position with the average loan to value ratio under 50%. Plus, we're seeing the lowest percentage of underwater homes in history. This housing market is built differently. And it's the complete opposite end of the spectrum from where we were in the middle of 2000s. Completely different. You can't even compare the two. They're on the opposite ends of the spectrum. Lance Lambert says minus 12%. How much U.S. home prices as measured by the Case-Shiller National Home Price Index fell in 2008? That was the biggest ever one-year drop. Keep that in mind when you see people on the internet throwing out these ridiculous things of minus 40%. That was the biggest ever, minus 12. But you know what? We're going to do some, 3 times, 4 times that. Yeah, sure. When government picks winners and losers, it usually picks losers. Thanks to the Trump administration picking Bitcoin, Wall Street is winning bigly, misallocating capital to Bitcoin and related value-destroying businesses. Becoming the Bitcoin superpower makes America weaker. And he has a point there. I was looking at this. I'm like, well, if you own Bitcoin, what does that do for America? Absolutely nothing. But what if you put money into roads, bridges, infrastructure? That's going to help us. What are we doing here? Why are we doing this? What is the motive behind buying a bunch of Bitcoin? Why are they trying to get people to buy Bitcoin? What is their motive? Why do they want to suck people into Bitcoin? Are they, what is, I don't know. I don't know what's going on here. Silver is now clearly thinking about going for a historical breakout for sure. And I know we were down today. I get it. But the mother of all legit looking probable cup and handles, that pattern still exists. And I just think it's another buying opportunity to buy it whenever this thing peters out. And then we've got Charlie Munger. The great home run hitters do not remotely swing at every pitch that looks halfway good. They wait for one they can really handle. That's what great stock pickers do too. But that's where I'm going to end it, guys. That's what we got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got that Black Friday coupon code. It's one word. And we have a Sunday question and answer session that we're going to talk about portfolio allocation, risk, and all that stuff. So that's what we've got. We'll catch you next time. This is Finding Value.